Hello, my name is James Davis from upad.co.uk. Today I'm joined by Ray Boulger from Charcol Mortgage Brokers, and I wanted to talk about how lenders are changing sort of the stress testing, the affordability of us landlords when we're wanting to get a mortgage. There's been changes recently in terms of mortgage derivatives and having to take effect of what the EU are doing. How do you see this changing, Ray, in the future? Is it going to be harder for us to get lending of a certain amount or easier, or is it just going to be different?
I don't see any signs of it getting harder because, if anything, we've seen lenders tweaking their affordability criteria to make it slightly easier. But there are a huge number of variations in terms of the rates that lenders use. So there's two key rates here. One is the interest rate used to calculate the maximum affordability, and the other is the percentage of the rental income which you're going to take. So typically lenders will use 135, 145%. They'll want that sort of cover over the rental income.
So the rent needed to be 135% of whatever the mortgage is costing as a stress test.
That's a typical rental cover rate. And if it's a buy-to-let mortgage owned by a limited company, then because the tax rate is likely to be less, some lenders will apply a lower stress test in that respect. So that's one of the other differences you might have if you own your property through an SPV. You may be able to borrow more. But the other key point is the Bank of England, through the Prudential Regulation Authority and the Financial Policy Committee, require lenders, even though buy-to-let mortgages are not regulated by the FPC, to actually stress test. And the rule is that lenders should stress test by using a revert-to rate plus 3%.
Right.
So if you're reverting to a standard variable rate of, say, 4.5%, they should be stress testing at 7.5%. However, that rule does not apply if the initial rate is fixed for at least 5 years.
Right.
And what we're seeing much more in the buy-to-let market than in the residential market is lenders using that flexibility to actually offer people a higher mortgage if they're taking a fixed rate of 5 years or more.
Which is hardly a bad thing, because you certainty for quite a good period of time.
Absolutely. I think for a lot of people, a 5-year fix makes an awful lot of sense. The difference between the rate for a 2-year fix and a 5-year fix has narrowed quite sharply over the last year or so as interest rates spreads have narrowed. And so taking a 5-year fix gives you longer term protection. You're not paying that much more than with a 2-year fix. And of course also you won't have the remortgage cost in 2 years' time. So there will, I think, for a lot of landlords be quite a lot of reasons to think about taking a 5-year fix.
Wasn't there also some noise about sort of the term of an accidental landlord, somebody with 1 or 2 versus a portfolio landlord, 10, 20 properties plus, that being treated differently, or did that fall by the wayside?
No, that's absolutely in place. So if you have 4 or more mortgaged properties, then the Bank of England requires lenders to treat you as a portfolio landlord.
Right.
And whereas if you only have up to 3 mortgage properties, the lender only has to look at the affordability for the property that they're providing finance for. If you have 4 or more, they have to look at your overall affordability. Right. So it might be the property you want to get finance for would have adequate rental income to support the mortgage, but if some of the rest of your portfolio is underwater, you might still not be able to get the mortgage.
No, interesting. It's ever complicated in the space. Ray, thank you so much. Thank you everyone for joining us again today. We look forward to you joining us on future webinars and videos. Thank you very much.